Hi, I'm Jason, and in this video I would like to show you how you can analyze any stock. Before making this video we looked at some other similar videos on YouTube, and while some are pretty good, most are quite general still. So for this video we wanted to make it more informative by going over a few practical examples. We want to show you that you don't need a PhD in finance at all, and instead can rely on a few different graphs and numbers. This video is going to be comprehensive but fast, so feel free to pause at any time. Essentially, stock analysis could be broken down in 4 different parts. To start, we need to understand the business. Secondly, we need to understand its financials. Thirdly, we need to look at its qualitative aspects like competitive advantage and its strategy. And then lastly, we need to buy it at the right price. So how do you start to understand the business? So the first thing you can do is look at the company's profile and visit its website to understand the products and services that they're offering. A second thing you can do is go to their SEC filings, read their 10K annual report as well as their quarterly report to understand more about the business. Lastly, you could even leverage AI to summarize the overview for you. Then once you have a sense of what the business is doing, it's time to move on to the fundamental analysis. Before we jump in, let's zoom out and let's try to understand what we'd like to see in the business. So the first thing is about the earnings. So the earnings, what we'd like to see is that it's growing, but that it's stable and predictable. Then the second thing is, okay, what is the business quality? Meaning, out of the total revenue, how much of the earnings is left over? So this means, how much margins does the business have? And then another thing about the quality is, how much capital is in play to generate the earnings? And lastly, we want to know, as business owners, okay, how much of these earnings could we potentially take out? So this is where free cash flow comes into play. So let's dissect earnings. The first thing to understand about earnings is that it's the bottom line or net income. So we take the revenue or the top line or the sales, and what we have left is the net income, earnings, or bottom line. So what we'd like to see is consistent growth or explosive growth, and what you do not want to see is declining growth, no growth, or reduced growth. And there are some nuanced examples, like for example, Tesla here has declining growth in earnings per share, but it has actually increased in revenue. And here's an example of a company that flipped to profitability. And here's an example of a company that was profitable before, then became non-profitable and flipped to profitability again. A key thing to note about earning is that the market is very sensitive to the earnings report. Take Mercado Libre as an example. In Q4 of 2023, its earnings released on the 22nd of February. Then if you look at the price, we can see here from the 22nd of February how the price reacted to this negative earnings. Here's another example in which you can see that the price follows the earnings. Next, let's dig a little bit deeper and see the income statement of a company so that we can analyze how much of the net income is left after the revenue, which will be the net profit margins. There are some companies that have low profit margin, Transmedics Group, Amazon is another example, and there are companies that have high profit margins like Nvidia or Microsoft. So what's a good net profit margin? Well, you can compare it with the S&P 500's average, which at the moment is 12.7%. So anything above that would be considered good, anything below that would be considered below average. Then if you want to go even deeper and understand more about the profit margins of the business, there's operating margin, EBITDA margin, and gross profit margin, which measures the profit margin for each product and services sold. Then to understand the quality of the business even more, we can look at its returns. A return on equity, for example, means that, let's say a company requires $10 million of equity to be invested to generate a return of $15 million. That means that the return on equity is 150%. Now, one thing to keep in mind is that young companies typically have a higher equity to liabilities ratio as opposed to mature companies like Apple or Coca-Cola. Apple or Coca-Cola have been doing share buybacks, which decreases the amount of equity, which increases the return on equity. This is why it's also important to look at return on invested capital, which takes the debt and the equity and then looks at the return generated based on this invested capital. This gives you a more holistic picture of how much capital is needed to get the return. So let's look at Apple here. As you can see, its liabilities far outweighs its equity, and this is how it's able to generate such a high return on equity here, 146%, compared to the S&P's average of 21%. Then if we look at Coca-Cola, we see the same picture, where the equity is relatively small compared to the liabilities. Then Semler Scientific is a startup where you can see the opposite. In fact, it has almost no liabilities and mostly equity. Now that we've looked at the earnings, the returns, and the margins, it's also very important to look at the free cash flow. And particularly, free cash flow per share is, according to Jeff Bezos, once the richest man in the world, the most important metric to assess the business. Just to illustrate how to get this result, we start with the net income, which after many changes results into operating cash flow. We then take this operating cash flow, subtract it by the capital expenditure, and we're left with the free cash flow. Since we spoke about Jeff Bezos, let's look at Amazon as an example. So we can see here in 2022 that there was a dip in free cash flow. So this is a result of a decreased operating cash flow, and we see that it has an increased capital expenditure. In such cases, it's very important to understand why there's such an increase in capital expenditure or CapEx. I suspect it's because they're reinvesting into the business, but let's find out. And as we suspected, that's exactly what they were doing. Additionally, it's very important to understand what a company is doing with its shares. So for example, a company might be continuously issuing shares, which will dilute you as a shareholder and reduce the earnings per share for you. Conversely, the opposite is positive. If a company is doing share buybacks, that means that your earnings per share will increase over time. And then lastly, it's very important to look at the shares float. Especially for young and small cap companies, if there's a low float percentage, it might put your capital at risk. In case the insiders start to sell, it will drastically affect the stock price. Now that we've gone over fundamental analysis, it's important to note that you can also use Streamline's quantitative scoring to essentially do the work for you. Next, let's move on to the qualitative analysis. To gain an even deeper understanding of the business, we need to understand its strategy and its competitive advantage. For this, we can look into the annual report, the quarterly report, the current reports, the press releases, and the news. Here's an example of how we can get an overview of Palantir's 8Q quarterly report. And here we can see its expansion plans. And here we can understand the strategy from Tesla's 8K current report. In press releases, we can also be aware of a change in leadership, of new partnerships, and of stock splits. We can also use AI to see its generated qualitative analysis reports. For example, here in Celsius Business Outlook, we can understand that it's using PepsiCo's network for distribution. And we can also get the analysis of management. Once you've determined that a company is a good investment, we need to also buy it at the right price. To do this, we need to consider two factors. The first is valuation, and the second is that we want to buy it at a good spot based on technical analysis. To understand valuation, it's important to note that certain stocks are valued higher than other stocks. For example, high market cap stocks are valued higher, and this is partly because they have many advantages as bigger companies, for example, distribution and sales advantage, but it's also due to the fact that certain big funds, like the Norwegian Sovereign Wealth Fund, have liquidity requirements. One of their mandates is that if they decide to sell a stock, it should not affect the stock price too much. And this is why the very few stocks that match their criteria will be having a higher valuation. Also, growth stocks are valued higher, and this is because the market prices its stock based on its future earnings instead of its current earnings. On top of that, stocks are very liquid assets, meaning that investors can buy and sell at any time. This makes it acceptable for a fund to pay a premium for a growth asset if they expect that the price will continue to rise along with the earnings. But beware, the moment the earnings growth will decline, you will experience a valuation compression as that money will move to other growth assets. The lesson here is that if you solely look at the price-to-earnings ratio, you might miss out on a bunch of these high-growth assets. The truth is that money goes into one asset to another, and this determines the valuation of a company as well as the fundamentals do. Note here that the S&P 500's price-to-earnings ratio is higher than the Russell 2000 price-to-earnings ratio. This is because the Russell 2000 consists of small to mid-cap companies as opposed to the big-cap companies of the S&P 500. Note how Immersion, a stock with a relatively low market cap of around 300 million, has a PE ratio of just 9.3. Here we see Palantir, a high-growth stock with an extremely high price-to-earnings ratio. For low-margin companies like Amazon, it may be important to not just look at the price-to-earnings ratio, but also to the price-to-sales ratio. As you can see here that the price to earnings ratio is higher than the S&P 500, but the price to sales ratio is lower. So far we've discussed different metrics to determine the valuation, like price to earnings ratio and the price to sales ratio. But you can also calculate the intrinsic value of a company using a discounted cash flow model. This method calculates the future expected cash flows to determine the value of the company. The discounted cash flow model consists of two stages. The initial stage forecasts the free cash flow for a period of 5 years, where the predictions are more reliable. Then in the second stage, we estimate the company's value beyond the forecasted period. Using tools like Streamline Finance, you can adjust the projected free cash flows, the cost of capital, and calculate the company's long-term value to get the derived value per share. Let's say that based on this analysis, you've decided that you want to buy a certain stock. I think the first thing to do is to add it to your favorites, your watch list, to keep an eye out on it. Then you can find a great entry point based on trend line. For example, you can buy it here at the bottom of the trend line. You can use resistance and support lines, or you can use a moving average to determine your entry point. So there you have it. We've covered how to understand a business, how to do fundamental analysis as well as qualitative analysis, and how to buy stock at the right price. What we've left out though is that it's very important actually to compare stocks with other stocks. This is how you make sure that you're buying the best businesses. But that's for another video. Thank you for watching.